Good day, everybody. Hope you are having the best ever day at the Best Ever Conference. I am very excited and we are honored to be a part of this event. We are excited to bring you the best ever content on all things related to multifamily lending and debt options. My name is Nate Trunfio. I am the Senior Director of Sales and Marketing here at Lima One Capital. Today, for an agenda, we are going to be covering the past, present, and future of multifamily capital markets and all things lending. So, what we're going to do is talk about where we came from 2019, which was a record year in all things multifamily lending, what happened through the pandemic that we've all heard and know too well and too much about, where we're at today, and specifically getting into some terms, as well as what we predict for the future. So hopefully by the end of this, you'll get a good understanding of what happened, why it happened, what's going on the lending side, what are your options, and where are we going from here. Please always feel free to reach out to us at limaonecapital.com or limaone.com. You can find us on social media at Lima One Capital or myself as well, Nathan Trunfio, on both LinkedIn and Facebook. Just to give a little bit of an introduction to who we are, Lima One Capital, we've been lending to solely real estate investors for a little over 10 years now. 2019 was our largest year ever. We did over $1 billion in transactions. We'll be exceeding that amount here in 2021, which we're super excited about. We have a knack for just being gritty and getting deals done. And we know that speed and execution is important to all people in multifamily, as your reputation is everything, and so is ours. We like to think we are good at doing that just because we're founded by two Marines. So that grittiness and the knack for just persevering through any sort of adversity to get to a goal is throughout our entire culture, our team, and all the products and processes that we offer and solutions for real estate investors. We do have a very diverse product suite, as we do lend in both single family and the multifamily realms. On the single family side, the good old fix and flip loans, as well as awesome single family new construction product. We also offer rental loans on single assets or on rental portfolios, which is actually something in the CRE world and circles has been talked about a lot more as a prime investment strategy, just because there's a lack of inventory in multifamily. But that leads us to our favorite product of multifamily. We predominantly write bridge loans, but in the next 30, 60 days, we're coming out with a multifamily permanent financing product. So stay tuned for that. The bridge loan products we write in two forms and fashions. One is a value add play, which typically value add for us just means some form of loan that needs us to finance CapEx and construction renovation money. We'll go up to 80% loan to cost, rates as low as the 6%, very competitive fees. This is for your medium and heavy lift value add deals. Very aggressive here. We'd love to see some deal flow from you. And then also our version of stabilized by no means holds the occupancy requirements of anything permanent financing or agency related. The bottom line is it's really for transitional lease up plays, Freddie fallout deals. You know, if an agency or perm lender can't fund quick enough, we can fund you in 3 to 4 weeks. But again, really strong product and helping just to provide solutions. That's the name of the game for us here. We are nationwide across 46 states. Nevada will be opened up in the next 30 to 60 days as well. All right, so let's dive into the content. Really excited to walk you through the journey of what happened on the lending side through this last exciting year. So where was lending at pre-COVID? Let's just be blunt. It was booming. There was all good things and tailwinds really helping provide great lending options to operators. Historically low rates. The proceeds we were able to provide and have been able to provide is the highest, really we've ever seen across multifamily lending. A lot of that was substantiated by some more aggressive, underwriting, and it helps to pencil out the higher proceeds. And really, no matter what type of deal you had, or there was a financing solution for it, with top-notch terms, and was really conducive for acquisitions, especially when inventory's tight. Pricings continue to go up and cap rates have continued to trend down, as you can see in the bottom right there. But all in all, man, there was just so much good tailwind coming from 2019. We hit $364 billion in dollars deployed in the multifamily realm, which is a 7% increase and a record high from 2018. You'll be seeing a lot of referencing to both small multifamily and small balance lending here throughout this presentation. 2019 was, again, a record high of money deployed into the small multifamily realm. When you hear small multifamily from economists and people that are a lot smarter than me, this is categorized as 5 to 50 unit complexes. When you hear small balance loans, that's typically loan amounts under the $7.5 million range. So I want to just quickly define that. I know that can create some confusion. Small and certainly mighty multifamily assets, tons of opportunity, and certainly an area that we live and breathe in here at Lima One Capital. By dollar volume, the GSEs, the government sponsored entities of Fannie Mae and Freddie Mac, really continued to bring liquidity to the market in 2019. They took up about 38% of the market share and were leading in that regards. But you'll see how that transitioned a little bit through the pandemic. Coming into 2020, we were expecting another record-setting year, 9% jump, getting up to $395 billion. And then the pandemic happened. So let's start talking about that, right? I think the image, as cheesy as it is, really defines well what happened to the debt and capital markets in multifamily. It came to essentially a screeching halt. Whether lenders ceased funding, a very small, thankfully very small few went under and didn't come back. A lot of lenders paused. Many certainly slowed down, even the ones that still did fund through. But we just saw a lot. I'm going to get into why some of this happened in a minute here, but the trends that we saw were just continuous change. The early phase of when the pandemic hit us, tons of uncertainty and really a lot of negative change for all things multifamily lending. Then there was a lot of change to get back towards better and equal to where we are now today, and more on that to come. Throughout this, it's definitely created an essence of more conservatism in how deals are looked at from a lending perspective. So we'll talk more about if that's going to continue or not. But thankfully, we also saw competitive pricing. So when I say pricing, I'm meaning really, rates and fees, terms that are, the tip of the tongue of anybody analyzing a lending option. We're still really competitive and strong throughout this year. So that was a great trend. And then the other trend is that the challenging deals, the ones that are less stabilized, maybe heavier lift or hairier, however you want to describe them, have become a little bit more difficult to finance. One of the things that happened naturally that didn't help us in the lending world continue to gain comfort and move quickly back to where we were was just there was a sheer reduction in transaction volume. A couple of stats to reference this is that 35% drop in sales activity in 2020, put out by Yardi. Also, in the early phase when COVID really hit and became, publicized in the U.S. here in, call it March, a lot of deals that were under contract fell out. Most of them got extended and then even fell out thereafter. We certainly saw that with our pipeline, but the amount of deals that fell out of contract was 7 times higher than where we were at in the averages between 2015 and 2019, which was certainly good times, but 7 times more deals fell out of contract. We understand why, but that sheer reduction in transaction volume certainly affected, how much money we could deploy and how aggressive we could get. We just couldn't see a lot of transactions and get the data on it. The other really interesting point on why is, and this is not only from Yardi itself, but my personal belief, why there's been less transactions in multifamily is there's just a big dichotomy between buyers and sellers right now. Buyers think they should get discounted pricing because of the uncertainty and potential risks in the market, but yet sellers see the cap rates and continue to compress, pricings continue to go up, and that they shouldn't have to discount their assets. And so that differentiation of opinion on pricing has really led to less transactions because until buyers and sellers are more level set, it's not conducive for getting a lot of deals done. So I'm sure many of you here listening in have experienced that, whether you're putting out LOIs or you're dispositioning properties and getting some bids that are, way under what market and your expectations to be. And, that should continue to tighten up as we get more clarity in what's going on in the market. So why did debt markets come to a screeching halt? I'm going to give you 2 simple reasons. One is money. The other is underwriting. So we'll make them the scapegoats of this. When I talk about money, it's really all lenders are capitalized, aka they get their money from different realms and routes. But what happened was most of the routes that any lender taps into, which a lot of times goes back to Wall Street and institutional type sources, they froze the money. So lenders couldn't get access to their lines of credit or to their investment partners that were typically helping support the funding of their loans. A lot of institutional sources made margin calls on lenders, and it really put them in a pinch. So that's just one thing. If lenders didn't have as much access to money, we couldn't deploy it as much. So that was one, really behind the scenes reason. Certainly high level, but you got to follow the trail of the money, and the money unfortunately dried up, especially early on in COVID. It's certainly prevalent now, and we'll get more into that. The other is, what the heck is going to happen to the mortgages we have out? Are they going to perform? Are they going to go into delinquency? Are they all going to need to be modified? There's a ton of uncertainty to that. And not only the performance there was uncertainty around, but how do you underwrite a deal? How do you size a deal? What's going to continue to happen to cap rates? How will collections continue to be affected? Will they get worse? Will they improve? All that uncertainty, we're now getting out of the thick of a lot of the COVID and seeing some of the trends, but that has really disrupted the debt markets, because underwriting and making sure we mitigate risk is an important part of providing consistent capital. As you see in the chart below there, all in all, performance has been pretty darn good, better than we probably expected here come March and April of 2020. What's been hit the hardest is the CMBS route in markets and channels. You can see that based on the comparison of delinquency. And then some of the other delinquency mechanisms might be a little bit, I don't know if I want to use the word jaded, but because there's a lot of modifications and forbearances that were offered and taken advantage of, and those aren't counted as true delinquencies. Sometimes they're not counted in the modification category. So there's still some uncertainty there, but overall, I think we're all pretty pleased and blessed to see that things have performed well, especially in the multifamily asset class among the many different lending type of channels and outlets here that we have in the multifamily realm. So let's get to the brass tacks, right? What happened to the terms that are offered to operators across numerous products? So first and foremost, rates. Initially, as you'll see in the upper right-hand chart there, rates went up very dramatically. I mean, to the point that almost lending options didn't even make any sense. But the good thing is they came back down pretty quickly. And I'm going to talk about what you don't see in the chart thereafter, sort of the July timeframe here soon. We also saw loan to values and loan to costs and essentially proceeds and leverage get reduced. You see that in the great chart in the bottom left-hand corner. And it also supports what I said earlier. We are at all-time highs in what we could offer for proceeds pre-COVID. Now we're dropped back down. I'll get to where we're at today and sort of what to expect soon as well. Lastly, I touched on this before, but because of the uncertainty in underwriting and how to make assumptions and size deals, underwriting just got tighter across the board. And one of the things that underwriters implemented and products implemented was reserves. So reserves were put in force, which is essentially requiring operators to bring their payments to closing. By bringing that additional money to closing, that essentially in effect lowered proceeds even more than what you actually see by that chart there, because it's not taken into account. But if somebody has to bring payments to closing and more money, when you look at the total capital stack, as they say, technically leverage was even lower because of that requirement. So we'll talk about where reserves are now. Throughout all of 2020 and even recently, there's been a huge refi boom in multifamily because of a number of reasons. Certainly less transactions, so less acquisitions, more focus on restructuring debt. Rates have been tremendously low, and it's actually been the highest level of refi activity that we've ever seen. All right, so what's happened since then? We said rates went up, but they came back down quickly, as you saw on that chart. They've actually, in many loan products and scenarios, surpassed and gone below pre-COVID rate levels, which is awesome, right? So that's a much better scenario when it comes to rates. Leverage, we're still seeing a reduction. It's been about a 5% haircut in almost all products. Almost. So the agencies, tout that they can still get to the same levels, although a lot of the effective terms offered aren't quite lining up with that. But it's about a 5% haircut in LTVs and LTCs across the board in all products. Interest reserves has varied. For the most part, the initial reserves put in place early in COVID have come back down a little bit across all products, but there's still been reserves that have stayed in place among many loan options out there. There's many variables that will depict this, but to get more specificity on the agency side specifically, Loans under 3 million still have a high and firm requirement of reserves, typically about 12 months for Fannie and Freddie, although they both differ a little bit. If you're looking at the $3 to $7.5 million range, there's a little bit more flexibility, the ability to get waivers on reserves and some lower requirements of the amounts. And then as you get into what you call the middle markets, the higher and double-digit million loan amounts, there's a little bit more flexibility. The lending and credit underwriters just deem the lower value loan amounts to be a little bit more risky for a number of reasons. But lastly, but not least, is underwriting guidelines have remained a little bit tight since COVID. Certainly, there was a big shakeup. We've seen some loosening in credit guidelines and policy, but I think that's a trend that we'll continue to see. Quick hitters on what happened among numerous different product channels, and this is ranked in who funded the most in multifamily. Commercial and traditional banks actually started to creep up and surpass the government-sponsored entities here as a result of COVID. Certainly, the government-sponsored entities, Fannie, Freddie, and FHA, still bringing liquidity and consistency to the market. So they're still doing great. They're both at about a third of market share, roundabout, maybe a little bit higher actually, compared to the rest of lending avenues. As we said earlier, CMBS and the CLO markets got completely blown out for quite a while. They've starting to come back, but that was really disrupted the most. Life insurance companies are typically known to be more conservative, and from what I've seen, they've continued to be exactly that through post-COVID, and even now as today, but certainly very attractive terms. And then we at Lima One Capital fall into the sort of realm of REITs, mortgage REITs, and private lenders, which has been the fastest growing segment in all things lending and multifamily. So we're very happy to be a part of that. Quickly, just to give you a real life example of what happened to our terms pre-COVID, post-COVID. On the leverage side, you can see 5% haircut on our as stabilized value on the value add deals. Pre-COVID, we could go to about 80% for rate and term on stabilized deals, is now down to 75. So again, there's that theme of 5% haircuts. You'll actually see our rates and our origination fees got tighter. We got better and improved post-COVID. It's really because we want more good deals, so please bring them to us. And then related to reserves and underwriting mechanisms, you'll see we upped a slight increase in debt service coverage requirement on the stabilized deals from 1.0 to 1.05. So not a big change there by any means, but a little one at that. And then reserves, the only real change we had is implementing 3 months on the stabilized product. On all value add, heavy, medium lift deals, it's very deal dependent on reserves, but we've been putting out a lot of quotes without them on those products, especially for good sponsors on good assets. But this will give you a good idea of, again, what I've said before and showing, how changes were implemented and affected us in lending. All right. So last portion here. What does the future look like? Well, I'm happy to say, grinning ear to ear, saying that we are very bullish in 2021. Out of a poll that was taken, 98, so almost all investors say they're going to grow their portfolios, 60% of them by more than 10%. So a lot of people are really bullish as well on this upcoming year. We've seen a lot of people are also planning to transact in this first quarter that we're in here today, which is really exciting. Colliers expects a 50% surge in investment activity, so they think the floodgates open up second half of the year. But if you look forward past 2021, a lot of the expectations are that the downside risk is going to come into play, and we might start to see some of the further distress. A lot of that ties to the macroeconomic factors of unemployment. What's the government going to do to support the economy through stimulus actions? What happens as loans come out of forbearances, modifications? Are rent collections still strong, or do they go back the other way? A lot to be seen, but I don't think that a lot of those downside risks are going to come into play in 2021. We're very bullish and positive on that. I think it's important to say, the lending market was scapegoated in the original or the crash in the 2000s. It's been fundamentally strengthened since. So a lot of really good lending practices are going to make sure that lenders like us aren't the scapegoat. As far as the money, there is going to be a lot of it. Fannie and Freddie have their mandates to grow, and especially in up and coming areas, which is really exciting. But it's not just Fannie, Freddie, and FHA that are eager and have money to deploy. It's all the other realms that we talked about. So your traditional lenders are going to continue, and banks are going to continue to grow their market share. Us in the REIT, the mortgage REIT, and the private lending realm, we're continuing to chomp away. And we just got a lot of good money for good deals. Rates will remain low. We are excited about that. Hope you are too. I do and will say we expect proceeds to be similar to where they are at and a little bit reduced from pre-COVID levels just because of the perceived uncertainty and risk out there. And then the theme is still going to be throughout this year, the cleaner deals, less risky deals that are more stabilized without a heavy lift will be the easiest to finance. The heavy lift, the harder deals are going to be harder to finance. My last piece of advice for all of you out there in the investing world, it is more important than ever to come prepared diligently with a good lending packet and presentation of your deal. So have good resumes put together on yourself as a sponsor and operator, put together good market data, make sure that your pro formas are tidied up and conservative with their assumptions, be realistic. It's hard to assume a cap rate play to show value, meaning we don't expect cap rates to go down. So if you're showing that to create most of your value, it might be tough for a lender to find that to be agreeable. But the bottom line is make sure you use your diligence before you present to lenders. There is a lot of money out there, but you will put yourself in the best position to get the best terms if you put your best foot forward in that. So we would love to help you and be a financing option for you and provide some solutions for your acquisitions and recapitalizations and refis. You can find us again on all social medias at Lima One Capital. Find me, Nathan Trunfio. We're here to provide a lot of valuable content. You can lastly apply and inquire at apply.lima1.com/multifamily, apply.lima1.com/multifamily. We hope you got a lot of value out of this. We're looking forward to working with you here in this upcoming exciting and bullish year. Happy and safe investing out there. But there's a lot of money to continue to make here in the multifamily realms, and we are excited to help you do that. So thank you all for your time. Have a great and best ever rest of your day.